Hey guys, nice to see you again. And before we actually finish with fixed income security and move on to equity discussion, we have one more lecture, which is today's lecture on fixed income security. And today we're going to focus on corporate bonds and default risk. And by the end of this lecture, you should be able to understand an example of securitization and how securitization can actually help to to help attract buyers for certain bonds. So, if you recall from the last two lectures when we discussed about fixed income securities, we went through a pure discount bond and a discount bond, and we learned how to value this kind of bond, which is a little bit complex. And today we're moving on to something similar. Basically, it is a corporate bond. It works in a similar way. In the same way as the as a coupon bond, because a corporate bond is usually something that actually pays at a particular period of time, like 1 year 3% yield, second year 3% yield, third year 3% yield. It works like this. So it's something like a coupon bond, but it's issued by the government. But it's issued by corporations instead of this government. So it's a bond set by these enterprises that aim to borrow money, especially during situations when they cannot really make sure their stock market equity finance can be successful, or their equity finance price is not going well, cannot really attract enough investors for their stock market, for their stock investment. That is why many corporations also issue bonds. So some industry overview, terminologies. Default risk. What do I mean by default risk? It is when a debt issuer fails to make a promised payment. So, for instance, if a bond aims to pay you 10% a year, and if it doesn't make it, then there will be a default. So a default risk is actually the risk that the debt issuer will fail to make a promised payment, which is the interest or even the principal sum in the end of the year of maturity. And the credit ratings is really important that I haven't actually introduced to you in a clear way throughout the last lecture. But the interest rate but the credit rating is basically given by rating agencies. The most popular ones, maybe you know about it, are Moody's, S&P, and Fitch, and they provide indications of the likelihood of default by each user. So let's look at the risk. Let's look at the credit risk rating here. So there's AAA, AAA. There's actually AA. There's A. There's BAA, and then it is no investment grade. So bond actually mainly people do buy bonds of different kinds in this table, but the highest ranked bond is actually AAA, and moving down, the high quality is AA. So let me now ask you the question from this rating, and please ignore the smaller a. Moody's is basically using smaller a, not really like what S&P, Standard & Poor's, and Fitch are doing, but they actually indicate the same rating. Okay, let me ask you the question. Now you see AAA and you see C here as well. Maybe there's even D. Yeah, there's even D. Which one do you think provides more return to the investor? Let me ask you this question. Let me repeat again. Now you have AAA, AAA, C, and D. Which one do you think provides most return? Yes, the answer is it is C and D. Why is it? Why does this low-ranked bonds below this investment grade threshold actually provide more return compared to these high-quality bonds? This is because since they are highly risky, they have to increase the return in order to attract the investor to buy certain bonds. So that's why, actually, even though you see the ratings are pretty low, but this rating is not like your school grade rating that some people get A+, some people get C-. Many people do like to invest in C and D, and these are the people who are doing these hedge fund businesses who are willing to take some risk. Because AAA, even though it seems pretty beautiful, it seems highly ranked, they provide less return, and the price is pretty high. Why is it so? Because since they have a high chance, if it's rated AAA, it has like 95 or above, even 99%, I would say, chance of returning you what it has promised. So it has a pretty low or almost no default risk, like the US T-bill, like US Treasury bill is most recognized example when you come out with a AAA rating. However, not all people invest in this. The hedge fund folks actually look down below to see whether it's possible to invest in this highly risky asset. So if you are someone who doesn't want to take any risk, you are happy with a little return, a stable return, you should go with AAA, which I think there are many AAA in the market, not like you can't find it, because there are AAA choices. But if you're someone who want to be a little bit adventurous, you can attempt A or BAA. But let me clarify something for you. If you want to make future investment, the BAA is like a median grade, like a passing grade in your exam. For instance, it's like if 60% is a pass, BAA is like 65%. So it actually nearly falls into no investment grade. So if you want to be adventurous, you should consider and think carefully, contemplate about it before you go with BAA. And if you're super adventurous, which are these hedge fund stocks, then you can try this highly speculative, most speculative, imminent default, and default bonds. So you can give it a try. And even in government, even if today I'm introducing you credit rating under our talk on corporate bond, but government bonds do fall into this no investment grade categories as well. But not being biased, but usually these developing nations like Latin America or like Africa, they do not really achieve the great. In average, they do not achieve these ratings above because their government's economy and budget is not stable as well. Unlike U.S., at least the government is able to print the money. Even though there's an intuition, the government owns a printing press, so they're actually able to how do I say, government in a theoretical point of view should be able to return the money because they own the printing press. But if they return the money by printing money, they're scared of inflation. So even though government, although it seems like they're quite stable in terms of returning just 3%, 5% to you, but when everybody's buying loans from the government, and the government does not have enough budget to return the money, no reserve isn't enough to allocate to the investors, and they don't want to print the money because they're scared of inflation, then the government can fall into this no investment grade category when they're not able to return the money. So even though I think I've been emphasizing that I think T-bill is quite a good choice in terms of it is actually a pretty stable return if you buy T-bill, which is a U.S. Treasury bill. But that doesn't really indicate that every country in the world, if the bonds issued by the government is guaranteed to be safe. So that is about rating. And I want to elaborate a little bit more in terms of showing you an example how a rating looks like. Because yesterday I downloaded a rating straight from Moody's, and let me think if I can actually find it for you. Yes, it looks like something like this. Can you guys see? Yeah, so this is my downloaded Moody's rating list from yesterday, and now it's during the COVID crisis. I'm making this class in 2020, and you can see the rankings not going that well. This is Moody's speculative grade liquidity ratings, and yeah, updated each business day. Many are negative, stable, not going so well, CAA, BA. Yeah, so some enterprises can be highly risky. So this is just an example of a Moody's rating. And I want to elaborate a little bit more. Many student assets. How do these credit agencies actually decide on I should give you a AA, AAA, BAA, or C? They don't give it by saying, today I feel like it's a AAA day. Today I feel like it's a BAA day. They give the rating based on the research, on the record, on the market data, and looking at historical data as well. So basically, since Moody's, S&P, and Fitch are these highly credible businesses, highly recognized businesses for investors to see the rating. Therefore, this business is actually the best in terms of providing rating. They have sort of work, everyday rigid work, to provide the ratings. So, do they make mistake? Absolutely. The market is highly unpredictable, so they make this AAA or BBB mostly based on the current situation now and historical rating, but they're really unable to predict the future like no one else could. Therefore, even an AAA ranked business may go down, and theoretically, everything is possible for C to raise to AAA, for AA to jump back to C, are possible. Here's an example. So here's a BAA 10-year Treasury yield. So this is actually a diagram showing you a BAA 10-year Treasury yield. And if you look at this graph right here, you can see the drastic change. The trend is pretty drastic. That is why, the hedge fund folks, they're willing to take some risk. They can try up, but when it goes down, it really drops drastically. without many chances for a turn back. Okay, what is a premium? Now you guys know about credit ratings, and now we should understand what do I mean by premium. So premium is actually the expected default loss, tax premium, systematic risk premium. So premium is basically, I'm going to show you this diagram right here that may make sense later on. It is basically a part can be tax premium, systemic risk premium, and for A-rated industrials, for A-rated bonds, there is actually a 17.8% contribution from default. And default recovery, tax, jump, liquidity, market factors can all affect default, can all contribute to the situation of default, and there will be 5 to 22% contribution from default. It can be credit risk, illiquidity, coin conversion features, and tax treatments and corporates and treasuries. There's another 20 to 30% of contribution from credit risk actually, from the carrying cost, taxes, or simply pricing errors. As I mentioned in the last lecture, remember, we talk about pricing errors, simultaneous equations. When there's no solution, be excited, you can take advantage of an arbitrage. Not only you or someone else, like investor or remember last lecture I talked about Solomon Brothers. These people, these firms will get large profit from this arbitrage. Not only that, but the person who made the mistake, the business who made the mistake is actually making huge losses. So don't think arbitrage is only if you are working in investment bank or financial services company. Do not think that arbitrage only affects you. Do not think arbitrage only means other people can get a profit. Absolutely no. People don't get a profit in the air. Other people get a profit, then it basically means you are not getting profit and you are making losses. That is why other people make a profit with arbitrage. That's how it works. So don't think I have to emphasize a lot on this slide because it's basically breaking down and telling you that when there's a default, the reasons that can contribute to this default can be market factors, microeconomic forces, can be tax issues, or just liquidity of the market overall, can affect investors and eventually affect your bond, and also carrying cost or pricing errors. So these are the prominent ideas proposed by famous professors and researchers. Okay, now I want to a little bit more terminologies right here. Not really confusing, I think, compared to the last few lectures when we talk about the future rate, forward rate. Let me actually recall future rate and forward rate again. So future rate is the spot rate between T1 and T-1 when we don't observe and we don't know. Forward rate is today's best guess of the future rate, and spot rate is the interest rate between T+1 and T-1. Okay, so decomposition of corporate bond yields, we have 4 different parts. So first is the promised yield to maturity, YTM, which is a yield if default does not occur, which means no risk, which means the risk did not really play a part. And the second terminology is expected yield to maturity, which is a probability weighted average of all possible yields. And there's a default premium, which is the difference between the promised yield and expected yield. Promised yield is basically if default does not occur. So we are making an assumption right here. And expected yield is actually the probability of the yield. So sometimes, even though, so what I mean by that is, I'm going to elaborate in a second, but it's pretty easy to understand is that, for instance, if a bond has 80% chance to actually be redeemed $10,000 without risk, you yield 5%, but it says only 80% of the chance. So that means the chance is 80% here, expected yield to maturity. You have to times the price by 80%. But the promised yield to maturity is when we don't say 80%, but we say maybe it's 100%, when the 20% risk does not occur. And the default premium is basically the difference between these two. And then we have last terminology, which is the risk premium, which is the difference between the expected yield on the risky bond and the yield on the risk-free bond of similar maturity and coupon rate. So risk premium is a term that you have to learn, especially in the future lecture when we talk about capital asset pricing model, is that risk premium is basically the difference between a bond that is risky or a bond that has no risk, which we refer as risk-free, or you can use the number we refer to as risk-free rate. And for this particular bond, there's almost no risk actually. For instance, the treasury bill. Okay, now I'm going to show you an example, so you can read this later on, but I'm now going to show you an example on. Before I show you example, actually, just decomposition of corporate bond yields in average. We see that 12% is average promise yield to maturity. So from this data, you can actually see that corporate bonds are more risky than government bond because it is not likely to get to see this number in the government bond, isn't it? Not really likely to see 12% as a return on a government bond, to be honest, in government coupon bond or a government strips, which is a pure discount bond. And you can see the 8% is actually the default free rate, and there's a, and then the 4% that lies between here, a part of it is a risk premium, and a part is a default premium, which means it has a chance, 3% chance it will fail in average. Okay, so pretty easy. Okay, now moving on to something really interesting, and I'm going to show you a innovation in finance engineering. So the last part of this lecture focuses on subprime crisis. So basically, it's a subprime crisis, subprime mortgage crisis that you guys may know if you were born before 2006. And that was during the housing bubble in the 2006 that actually eventually led to the recession. And the housing bubble was one of the largest reasons that led to the recession. And sometimes now, in the end of this lecture, in this part of our lecture, third part, I'm going to focus on how do we sell unpopular bonds to the market. So if a bond is not popular, how do we sell it into the market? Do we have any chances? So we actually are capable of selling that into the market, but we have to securitize the loans. And that is the process of securitization. And securitization basically refers to us, the market, repacking risk to yield more homogeneity within categories. So we will have a more efficient allocation of risk, we're creating more risk-bearing capacity, we're providing greater transparency, blah, blah, blah. So, however, we require diversification and accurate risk management, otherwise securitization is not going to really work. So I'm now going to show you, I'm going to actually go back to this slide after I show you this example, and I'm going to let you guys read about the sentences later on. But now I'm going to show you a really interesting example. So, the loans are highly risky and their default rate is 10%. So they have a probability of default 10%. Now let's illustrate the example. So we have two identical bonds, and the bond has a 90% chance of yielding and 10% chance of default. And if we use the probability just to give a price, we should price it at $900. But however, these two bonds are not so attractive. If we go back to the rating agency, they are rated not even A. They're like BAA. They're like BAA. So now, if I have two of these bonds, I can't really get them sold in the market. Do people really want to buy it? I don't really know. They don't seem really popular. Even though it says 90%, but a 10% default in the bond market is not really attractive. Honestly speaking, if you actually start trading, you'll understand what I'm speaking now. So 10% of default rate is actually pretty pessimistic. It's not optimistic at all. So if I have two bonds here, if I'm working in an investment bank in charge of selling these two bonds, it is pretty difficult for me to actually sell them, right? If I talk to you guys now in the class, who wants to afford $900 to buy this bond? I don't think anyone wants to buy it, right? 10% default rate, but you spend $900. No one is going to buy it. Even professor tried this within the class. No student want to buy it at 900, even not 850. So then we are decreasing the value of the bond to sell it over. So we have to decrease it to like 800, and we're actually making losses as brokers or the financial services employees. Now I'm going to show you guys a magic in terms of we're trying to shape and trying to put both of them into your portfolio. Okay, imagine we're putting both of these bonds inside a portfolio and we're going to sell them together. So now the portfolio value is like tossing a coin. If you guys still recall your high school math jog, if you guys are one of these high school math jog or just math aficionado, you should be able to understand how to do this so-called probability when you have two different objects like tossing a coin. So let me ask you the question: what is the chance to get tail for both coins? So it will be 1/2 times 1/2. You multiply and it becomes 1/4. So that's how it works. So same thing here, we'll do multiplication. So the portfolio value, 1,000 plus 1,000, it becomes 2,000, and the probability becomes 98% because we multiply 90% with 90%, 0.9 times 0.9, and what you get is 81%. And 1,000 is when, and I'm going to guess this first, $0, the probability of yielding $0 is only 1% because 10% times 10% is 1%. And the rest is yielding the $1,000 or one bond, and another bond doesn't yield any return. So now I'm organizing two of these bonds into one portfolio, and seemingly, kind of it looks better. And now let's see how. Next step, what do I do? So now I have two bonds in the portfolio, but if I still sell it over, it doesn't make any sense. It doesn't really increases attractiveness in the market. So what I'm doing now is I'm going to allocate two of these bonds and name one of them as the senior tranche and other one as the junior tranche. So tranche is actually an English word derived from the French dictionary. It actually means a portion, especially especially referring to money. So a senior tranche and junior tranche. So now I'm actually reallocating these two bonds. And the senior tranche, I'm going to allocate this $1,000 to the senior tranche. So just now, if you recall here, actually I mentioned that there's this probability that one of these two bonds is going to yield 1,000 and another bond yield $0, right? And I'm going to assign this $1,000 to the senior tranche. So now the senior tranche looks pretty good. And for the junior tranche, you won't get this $1,000 and you will get $0, $0. So right now, senior tranche and junior tranche have separate values. Senior tranche worth more value compared to before, which before we have equal value. You remember the green notes right here, we have 0 value. But now I'm increasing the value for the senior tranche and decreasing the value for the junior tranche. And let's now, and it now looks something like this. Do you guys understand? So let me repeat again. Let me actually explain the table, explicate the table one more time. So the portfolio value is $2,000, and there's probability that each tranche gets $1,000. So here I will leave 1,000 to both junior tranche and the senior tranche. However, there's also 18% of the chance that one of these bonds is going to yield $1,000. And because before we have two identical bonds which are not attractive in the market, 10% default risk, 10% default risk, and 10% default risk, price at $900, doesn't seem attractive, too much risk to take. And now since there's 18% chance that one of these two bonds is going to yield $1,000, I'm going to assign to one of these bonds, and now I'm going to name it senior tranche. And absolutely, there's also 1% chance, theoretically, that both bonds are not going to yield anything. So in the end, what we're getting is we see a more senior tranche with more value and a junior tranche with less value. And now, if we actually link back to the credit ratings that we did, now before I mentioned that both bonds are lie into this category of BAA, not really attractive, 10% default risk. But now the senior tranche has a higher rating. You will probably move on to AAA, and the junior tranche is probably going to go to BA, so you will decrease its value. However, this is making this investment much more attractive because in this way we can use a different way to price our two bonds, to price them differently. So before we have two identical bonds lying within this category, maybe the end of A to BAA. Now we're increasing and raising the value of one of this bond, which is our senior tranche, to AAA, and our junior tranche to BA. And now let's see how do we value that. Using simple probability, when we use 81% times $1,000 and plus 18% times $1,000, we eventually get $990. And if you do the same probability multiplication again, you'll get $810 for the junior tranche. So now in the end, you will actually have a different way to price a bond. Originally, it was $900 and $900. Now it is $990 and $810. And if I add them together, it still adds up to $1,800. So in the end, we're neither adding value to this portfolio, to these two bonds, nor destroying the value. So actually, this is a simple explanation of securitization. However, in the real market, because we have correlation issues, we have to accurately plan the securitization, otherwise we may be making huge losses. But just in a nutshell, this is how it works. So now, since we finished with this simple example, let me give you the official definition of securitization. So securitization is the process of taking an illiquid asset, a group of assets, and through financial engineering, transforming it into a security. Security is a fungible and negotiable asset that has a monetary value. And financial engineering, if I want to give a definition, is the application of mathematics to solve problems in finance. So we're using financial engineering to actually reallocate the group of assets to turn them and transform them into a more attractive security. Even though we are not destroying the value, but we are kind of adding value as well. Because we've added value for the senior tranche and decreasing the value for the junior tranche, which actually canceled out. But those people who buy the senior tranche actually are those people who can take less risk. And for the junior tranche, we can price it like lower price and more risk. But in the end, since we're sold in the portfolio with the assumption that the junior tranche has to be sold after the senior tranche has been sold, there's more probability that we can attract more investors, isn't it? So just look back again to think about it. Okay, and now, actually, just now the discussion seems pretty interesting, pretty surprising that we're actually able to turn into two unattractive bonds to attractive bonds. But however, what if that was under the assumption of two bonds are not correlated at all? But what if they are highly correlated? Then this argument won't even exist, because if they're highly correlated, when the other doesn't yield anything, the senior tranche can't even yield $1,000. So if we assume that both of these bonds are correlated, perfectly correlated, the whole securitization that we've done just now can be formulated at all. It can be formulated, because then we won't have this. We won't really have this situation that when a senior tranche can have $1,000 and a junior tranche earns nothing. This probability won't be able to exist. Therefore, we have to price it again at $900 if assuming both of them are perfectly correlated. Honestly speaking, in the market, they won't be 100% correlated, but they won't be 100% not correlated as well. Therefore, the securitization that I just mentioned won't be exactly what the market is going to have. It's not going to be exactly the solution. And now I'm really going back to the quote that I wanted to actually go back to. So this is actually written by a famous banker. And look at what he's saying. Like most banks, we own a portfolio of different tranches of collateralized debt obligations, which are packages of asset-backed securities. Our business and risk strategy was to buy pools of assets, mainly bonds, warehouse them on our own balance sheet and structure them into CDOs, and finally distribute them to end investors. We were most eager to sell the non-investment grade tranches, and our risk approvals were conditional on reducing this to zero. We should allow positions of the top-rated AAA and super senior, even better than AAA tranches to be held on our own balance sheet, as the default risk was deemed to be well protected by all the lower tranches, which will have to absorb any prior losses. So that person seems to be pretty happy and receptive to this securitization process that we were doing, increasing the value of the senior tranche to $990, decreasing the junior tranche to $810, and they believe it is highly useful because the risk can be backed up by the junior tranches, and those people, those hedge fund folks who are willing to take more risk, can buy my junior tranche at a lower price and take the risk. Those people who want to take less risk, willing to spend more money, can choose my AAA bonds. Okay, now continue with the quote. In May 2005, we held AAA tranches, expecting them to rise in value, and sold non-investment grade tranches, expecting them to go down. From a risk management point of view, this was perfect. Have a long position in the low-risk asset and a short one in the higher-risk one. But the reverse happened of what we had expected. AAA tranches went down in price and non-investment grade tranches went up, resulting in losses as we marked the positions to the market. So now it's getting interesting. Now the person is speaking the completely reverse part of our securitization process that we were admiring about. So securitization not going to work if correlation is an issue. If correlation do alters in the market, if there will be a higher correlation, then we're actually decreasing the changes, the differences, the disparities between our senior tranche and junior tranche. And sometimes, like what a banker has said, published in the Economist, that sometimes the reverse can happen when AAA tranche is going to go down in price, and non-investment grade tranches, which are C, D rated, B rated, the bonds actually went up, resulting in losses. That can be an issue as well. So this was entirely counterintuitive, right? Explanation of why this had happened were confusing and focused on complicated cross relations between tranches. In essence, it turned out that they had been a short squeeze in non-investment grade tranches, driving their prices up, and the general sell of all more senior structured tranches, even the best AA ones. So here's the reason why they actually seem this phenomenon of the reverse happening. Pretty interesting. So it is all because of cross relations between the tranches. So sometimes when we're doing securitization, we're assuming they are not correlated or weakly correlated. But when they're strongly correlated, there's not going to be any senior tranche or junior tranche, and they may even switch their position in the market, especially when we actually price in a detailed way. So we can drive their prices up, and the general selling of all more senior structured tranches, even the best AAA ones, people trying to sell them, because they now find junior tranches are more attractive. So that is about securitization, and pretty interesting discussion to share with you guys. And today I'm going to finish my lecture with some ideas to spark you guys to this basic story. What do we have to add? What considerations do we have to take when we price this bond when we try to securitize it? Firstly, ensure at very low default rates. And we have to make sure initially there should be low correlation of defaults. Moreover, AA for senior tranches. And demand for the senior tranche, for instance, are these pension funds mostly. Pension fund people like to buy that. And these junior tranches, these hedge fund people like to buy these junior tranches, they have high demand. Fees for origination, rating, we have to take account of this money, cost, insurances like AIG, American International Group. Remember when you securitize it, not only on correlation, but also know the market well. It can be a bull market, bear market, depending when you enter the market with the securitization, really determines the return in the near future. Then national real estate market declines, default correlation will rise actually. Senior tranche will decline, and junior tranche will increase. So this could be what just now the quote, the banker in the quote was saying. He could be the person in the 2008 housing bubble of the U.S., which actually later led to the recession, and he could be one of the person involved in selling this bond during that particular period of time, which was pretty risky, and the reverse phenomenon actually happened. Ratings could decline, losses unwind. Okay, so this is about our last lecture on fixed income securities. Firstly, the valuation of risk-less pure discount bond using MP12s. We learned about that. Coupon bonds can be priced from discount bond via arbitrage. Interesting. So with arbitrage, and current bond prices contain information about future interest rate, spot rate, forward rate, yield to maturity, yield curve. Contain our source of risk. So a little bit more about corporate bonds. This is our subject today. Is that compared to coupon coupon bonds and government bonds, since corporate bonds issued by the government, even though they are theoretically treated as debt, not equity, because you don't really own a part of this company, but sometimes it do turn into equity because sometimes they're unable to pay back, so you own a little bit part of their business. A little bit part to actually compensate the principal sum and yield that they won't able to return. However, in the end, corporate bonds are highly risky. They have risk premium. They do correlate to stuff like the housing bubble, to the whole financial market and the whole market of the particular industry. So that's about this. And in the next lecture, I'm going to be starting with equity finance. And today, still, if you haven't finished the reading, and I think it's really valuable to read this right now, because the part of reading that I wanted you guys to read is actually covers all 3 lectures. So we have 3 lectures on income securities, and you guys are supposed to read this 3 chapters over this particular lectures. So they are Briley, Myers, and Allen chapters 23 to 25. So today's the last lecture. Should be reading this, because you definitely should look back in the future when you learn harder finance. But in the next lecture, I'm going to go to equity, which will have a new reading chapter assigned to you guys. So today, hopefully, after class, you should pick up chapter 23 to 25. Okay, I'll see you guys in the next lecture. See you.